Hello and welcome. You're watching India Market Open. It's Tuesday morning. Global cues are fairly muted, but I guess it promises to be another very exciting and very volatile day of trade for us.
Yeah, volatility name of the game, but it's just very interesting how, we'll talk about it in detail, of course, I'm sure, but it's very interesting how while the FI positioning all through on the cash market has been different, the index futures and the stock futures positioning in the last 10 days is changing so substantially. It's pretty exciting for the Indian markets.
So substantially, how so? In the sense, are you seeing FIIs bet positively in the futures? Time. So essentially post 4th June. 4th June becomes the important barometer?
No, right. So they are already positioning themselves for the 4th of June in a big way. They're cutting shorts, building on longs. That data is fascinating, guys.
So you know, it's a mix of things and difficult to actually predict, because what happened in closing yesterday was astonishing to say the least. If you look at the actual close and you pull up the close for the Nifty, you'll probably see a flat market, all right? So not too bad. But look at that dip and the massive slide that you saw during the closing, about 150 points down from the highs of the day. And this was sharp and sudden as well. So now, are you putting it down to FII movement is one question. Are you putting it down to market election nervousness? But if there's election nervousness, where did that nervousness go through the whole of the day? What are you going to see today? So essentially, this is a market where one needs to tread carefully, I would say. And that really is the name of the game already. You know, you've had a volatile start to the week, and that might continue. I'll quickly set up the global cues for you. Not much happening because UK and US markets both were shut yesterday, US for Memorial Day. But stock futures in the US are giving you, you know, that's Nifty implied open. I'm talking about Dow futures, are giving you some sort of sense of where we're going, and that's okay. Those are mildly positive and up in the green, nothing great happening over there. Likewise, no action really on bonds, etc., because markets were shut. Crude is where the story is, I would say, and ECB as well, as you know, we were talking about before the show started, where ECB might be changing its view on rate cuts positively. Crude, all eyes are on a very crucial meet on June 2nd, when OPEC Plus we'll be talking about whether they want to extend production cuts for the US markets. All the action towards the end of the week, again, when you'll have CPE data, consumer sentiment data will come in. So those will be the factors to look out for. As of now, the Brent still around the $83 per barrel mark, so nothing great happening there. I'm going to quickly pull up Asia for you, which had a sort of a mixed start. And yeah, that continues right now as well. So muted and mixed is how I would describe Asia. We'll go back to that implied open because that number is interesting. Higher than what we've seen in just terms of what the implied open is over the last few days. So after the hit, so to speak, on investor optimism, you are seeing a pullback perhaps this morning in the first few minutes of the session. I want to pull up FII and DII flows because you know, what happened yesterday becomes the key question. And FI flows were just, you know, outflows were just about 541 crores. Nothing great. For the DIs was about 900 odd crores as well. So you have a situation where I think no one has any doubt, I would say, majorly, or real concern about what's going to happen on June 4th. But nevertheless is not willing to stick their neck out or put the money where the mouth is, I think is one way of looking at it, one would suppose.
Yeah, on the cash side, most certainly. On the future side, though, it's looking very, very interesting. So, and that's the part of the trade setup. Here's some data, just putting out some data out there. So, FI short covering and long build-up continued on a volatile day as well yesterday too, because if you just look at what happened with the long-short ratio, that's the first number. The long-short ratio was at 42.11% on the 23rd of May. The long-short ratio is at 48.75% as of yesterday. So even on a volatile day, on the index side, the shorts were being cut and the longs were being built. Now, look at the data for the last 3 days on the FI side, both on index and stock futures. So FIs added $1.43 billion worth of long index futures, and they covered $1.1 billion worth of short index futures. So both fresh long build-ups, presumably for post-June 4th or June 6th expiries, But on the short futures which were existing all this while, the covering continues. Even on the stock side, by the way, very interestingly, the FI side added $1.78 billion worth of long stock futures, and they covered $792 million worth of short stock futures. There is, if we are looking for a trend, it's not there on the cash side, certainly not, as Tamanna said, but on the futures side, there is a clear trend of FIs going long on both index and stock futures ahead of the election results. DIs may, and by the way, DIs too, I think on the DI side as well, institutionally, on the future side, things are the same. It's just that select clients are now taking money off the table, and on the cash side, people are not committing. But on the index futures and the stock futures side, there is a clear trend of staying long, going long, and covering the shorts.
And the cash buying could probably be a little more muted because Chinese stocks are doing well. From the FI angle, of course. I mean, the Hang Seng trades at a multiple of 9 PE, which is very, very cheap as compared to what India trades at. So maybe in the cash market, what the FIs are viewing this as sell India, buy China, but of course a very different picture emerging across the future space.
I just want to add one nugget because we were talking about FIs. Now this is the season where political analysts are in great demand by FIs, by stockbrokers, by everyone. So I was speaking to a couple of them yesterday, and they get called on, for their view of what's going to happen. And the persistent question that they're getting is that FIs are looking at what they see in social media, and that's because that's their first call, and are not very clear what view to make. So they're bullish, they're optimistic, but they just want to see that number on the screen on June 4th before they really
which is what I think I'd also mentioned the other day. They would rather buy expensive than buy uncertain,
so
right?
Be safe,
Be safe. So, but they're coming in. I mean, you can very obviously see there has been some improvement, some buying, but it's also a time when valuations are being questioned extensively. So while they don't want to miss out on this rally around the election outcome, it does seem like they may not be coming in lock, stock and barrel just yet, but it doesn't look bad as indicated. Well, Niraj highlighted a little bit of the trade setup, but a quick mention on that. While yesterday turned out to be very interesting, we made record highs in the first few hours of trade. Finally, the last hour and a half turned very volatile. The index shut below levels of 23,000. Bank Nifty continues to look good. What you want to note is that the VIX has jumped substantially. Again, par for the course, no surprises there. As we get closer to the June 4th event, you will see the VIX continuing to jump. But the last time you saw that level on the VIX was all the way back in 2022. Another quick mention is also the PCR, which indicates the bias of the bulls and the bears. Any reading above 0.7 indicates a bullish sentiment. The PCR went all the way up to 1.09 in the first half of trade, but by the time we closed shop, it had dropped down to 0.88. So that just goes to show that the tussle and the war between the bulls and the bears will continue. Bank Nifty is the shining star. We've said this again, and we will say it again, that 50,000 is in sight, but that only happens after Nifty Bank conclusively closes above levels of 49,600. So you want to watch that level on Bank Nifty. A closure above that will clearly indicate 50,000 in line of sight. So that's on Bank Nifty, and the broader markets also not doing too badly. But the theme continues to be elections. So anything to do with election, PSU, defensive, fertilizer, defense stocks, fertilizer, railways, PSU banks, that's where the buying is coming in, irrespective of what those valuations may look like. We are on the last leg of the earnings season. You've had a couple of PSU counters as well, the reported numbers. We'll start with LIC because that was the biggest number to report on. Those numbers looked okay. Net premium income was up 15.6%, despite LIC selling fewer policies in the fiscal, and they took a hit on its core earnings from first-year premium. They've still managed to earn 12% rise in their annual profit. So that's what you want to watch out for. Their VNB business has also seen a small decline, actually. So that's what I mean when I say new businesses hasn't done, or rather hasn't grown as substantially as watchers would want. APE has grown 3% YOY. Net profit has come in 2.5% higher. And what you want to keep in mind is that LIC has revealed that it's recorded a net profit of 40,676 crores on the back of higher income from renewal premium, which is, of course, earned from existing policies that are older than 12 months. Better income from investment activities and a slight increase, so very small increase was seen on VNB, which is about 0.2%. Remember, LIC is grappling with erosion of market share in the face of growing competition from private peers. It sold about 20.4 million policies in FY24, which was slightly lower than what we'd seen in last year. But despite low income from new businesses, they've earned on renewals, and that's what's actually helped earnings. Looking ahead, they've talked about a very optimistic outlook. They've talked about gunning for double-digit premium growth. They said that they will focus on top line as opposed to bottom line. Guidance for non-par was 15% of the mix, which is now at over 18%. So all in all, good set of earnings. They might have sold lesser, but the numbers actually look better for LIC this quarter. There were a few one-offs as well, which could have impacted earnings. Well, moving on from LIC to another PSU company, Nalco reported numbers, a strong set of earnings. They've clocked in a net profit of 996 crores, which is double of what was reported about a year ago. Their revenues come in marginally low, which was down about 2.5%. At about 3,579 crores, while margins have improved to come in at 30.9% versus 20.9% that was seen in the same quarter last year. Expenses were kept in check by lower prices of thermal coal and bauxite, which is a key raw material for aluminium production. But what you want to keep in mind is that despite lower raw material prices, which has of course impacted margins substantially, it's also the selling price of aluminium has been lower in the quarter. That's impacted their top line. So that's what Nalco is. Good earnings, nevertheless, lower cost, better operational efficiency, lower raw materials have led to a good set of earnings for Nalco. Natco, on the other hand, Natco Pharma reported earnings, a 40% jump in net profit at about 386 crores. Revenues from operation also increased 19% to come in at 1,068. EBITDA rose 46.6% versus 46.6% to report close to 500 crores. On the domestic business front, though, there have been a few one-offs that they've had to pay for, which is about 90 crores, reflecting in revenue and profitability numbers. On the crop health science business, due to a poor crop season, the stock returns amounted to 25 crores that was expected. Provisioning on that asset was about 30 crores. So that's Natco Pharma for you. Watch out for this one. Again, good earnings, but of course not euphoric like some of the numbers that you've seen over the last couple of weeks.
And pharma has been completely in focus even yesterday. I mean, what a day for Divi's. Torrent Pharma had good numbers. Aurobindo had decent numbers, but then negative news on US FDA inspections kind of killed the buzz there, I would say. Natco also might see maybe difficult morning. But I have one more pharma stock which had results come out to talk about, and that's AstraZeneca Pharma. And if you see the year-on-year picture, you've seen quite a dip in margins, which is something that the street might not like. But Q on Q is what one must also focus on, and that's also what the street is watching. So I'll pull up the Q on Q pictures or numbers, which sees revenue up 25%, EBITDA up 3.2x. It's gone from 15 crores to 49 crores. EBITDA margins have jumped from 5 to 13%, and net profit is up 2.5 times nearly quarter on quarter. Now, if you look at the annual picture, the reason why that's also looking, margins are looking hit is because of higher raw material costs, which when compared to revenue have grown 56% versus 35% last year. There was a low base which has boosted the overall net profit number as far as the year-on-year picture is concerned. But overall, it would be seen as a fairly decent set of numbers. So AstraZeneca is one to watch. Lumax Auto was the other one. We've been talking about how Auto and Auto Ank are both in focus over the last few sessions. Lumax Auto has had a fairly decent set of numbers, I would say. Revenues up 53%, year-on-year consolidated, that is. You have had EBITDA up 62%, margins are slightly below Bloomberg estimates at 12.1%, but a growth nevertheless. And net profits also at 51 crores. A lot of that coming from, the consolidation as well. Passenger cars contributed 48% to overall revenues, and 2 and 3 wheelers at 24%, CVs at 9%. They've also talked about the new launches that they worked on this quarter, which includes plastic products for M&M, Scorpio. So Lumax Auto, which has been, I would say, relatively tepid over the last 1 month, just about 2.5–3%, could be an interesting one to look at. And then, of course, there's, I would say, the rock star of the last couple of weeks, Cochin Shipyard. So Cochin Shipyard has already been on quite a rise, 45%, 46% in the last 1 month. But they did have some interesting news yesterday, which came in post-market hours that I thought I should point out. They've secured an order with North Star Shipping, which is a UK-based offshore renewable operator. And they're going to make basically a hybrid service operation vessel for this company. And now this SOV model is very crucial, because as more and more focus comes on renewable energy sources offshore, this is something that all of these operators are going to need, which is the SOVs. So this particular order is expected to be valued at about 60 million euros, and there is an option to increase 2 more contract vessels. So I don't know, in terms of valuation, if there is more steam left in a Cochin shipyard, I mean, how high can you go?
Question those things anymore, right?
But the fact is that if you look at their numbers, their order book, actually is looking good. Their profitability is looking good, and this order is a fairly big deal. So more good news, if nothing else, to add to the cheer for Cochin Shipyard.
Yeah, most certainly. So lots of interesting reactions expected there. I'll add a few more. Sumitomo Chemicals could well turn out to be one big rockstar mover of the day as well. Revenues were up 3.5% at 674, ahead of estimates, of course, at 651, in line with some of the chemical companies which are maybe not delivering on the revenue front as much, but the margin number. And that's where the kicker is, because for most companies, even if the revenues are flat, margins have taken a dip because they haven't seen pricing benefits. In Sumitomo's case, margins at 20.8 versus 12.4%. Splendid show on the margin front. The Bloomberg estimates were 15.5. The net profit up 52% at 110 crores versus estimates of 80 crores. Raw material costs as a percentage of sales were down to 59%. Versus 69% a year ago. Exceptional, one, very good raw material benefit, and 2, the pricing stability helps Sumitomo deliver a very strong quarter. I dare say watch out for this one, could be a very interesting one to monitor in the session today. The other one on the flip side though is GMDC. Now keep in mind, because it's a seasonal business, I'm comparing it YOY. You look at QOQ, it looks exceptional, but you should look at it ideally YOY. The YOY numbers, terrible. Revenue is down 20.8% at 751 crores versus 948. Margins at 27.4 versus 41.1. PAT down 53% at 207 crores versus 442 crores. Hasn't had a great end to the year. Dare say might show up in the stock performance in today's session, so do watch out for this one. And do watch out for Timken, amongst others. Timken Singapore is looking to sell about 6.6% stake in the company at about 3,550. The current price higher than the 3,550 mark. Very likely that Timken, which was down about 4.5% in trade yesterday, could well see a further corrective move today as well. So do watch out for this one. And by the way, speaking of Timken, guys, there are 2 other block deals as well, which people should keep an eye out for, Inox Wind and Concord, and all of them happening at discounts. So very likely that if the buying is not very high and convincing, then these stocks might start off lower and maybe even stay lower. If they don't, then you obviously know that the block deal is being consumed very well. So Timken, Concord and Inox Wind.
Yeah, I'm just going to add smaller micro-cap names that will be in focus, because these are the guys that see big moves in terms of trade. Vishnu Prakash, watch out for how that one reacts. Profits have spiked substantially, up 70%. Revenue's also gone up 45%. Jubilant Industries, again, very good set of earnings. So that count, there you go. Vishnu Prakash is already up 9% in trade yesterday. Will do well again in trade this morning. Jubilant Industries, good earnings, and SH Kelkar. These are counters that have seen a big jump in top line and bottom line. So watch out for 3 of them from the micro-cap space. On the sell side, I'm assuming there'll be Dish TV, very weak earnings coming in there. Borosil Renewables and Automotive Axles. These are counters that have reported weak set of earnings and could see some selling pressure in today's day of trade. So just those few that I wanted to touch upon. Smaller companies, but always very active and always preferred for some reason by some of these guys who look for hidden gems.
Yeah, and Vishnu Prakash Punglia, the execution has led to the best ever
very
margin performance for the
efficiently
company.
and operationally well-run company.
Historically, best margins for
I think the street might have known that, Niraj, because the counter was up yesterday. And another quick mention, Adani Enterprise, watch out for that one. They've got that board meeting lined up today, fundraising plans on the anvil. It'll be interesting to see what happens and what announcement comes
and a large number from Adani Energy.
So
that
Energy
happened
was
yesterday.
the one that I was mentioning. So the board has approved a fundraising plan for 12,500 crores through a QIP. That's one that you should also watch out for. Just Keystone Realtors as well. So they have raised 800 crores versus via a QIP, but again at a discount price to what the floor price is, at a discount to the floor price. So you might see some pressure there. So a whole lot of stocks to talk about, but I think the focus this morning is on FIs.
Just before we go there, if we haven't discussed Nalco, just one mention out there of Nalco.
She did.
The only thing is in Nalco, there is a royalty provision reversal, and as a result of which the aluminum EBITDA is actually slightly lower than what they did in the last quarter. So the street may reward the bit of a one-off because the margins have looked very good. But I think if the stock starts off with a bit of a pop, we might well see a bit of a reversal in Nalco.
Because you're saying those margins are a bit dressed up in the sense of
there are one-offs there. So that is one. And a couple of other stocks which look slightly iffy, which we haven't mentioned, just very quickly. One of them was LG Equipment. Revenues were up 3.6%, but margins at 14.5 versus 15.7, and PAT down 55%. So very wobbly PAT number. And Lakshmi Machine Works. It's an age-old stock. A lot of people love it. Not very liquid, but revenues down, margins down, PAT down. Very likely that this stock too could react negatively today.
Absolutely. All right. So, but while a lot of stock-specific news, I completely agree. I think the big focus is also on what FIIs are doing. We've been ignoring them for a good part of 6 months. By we, I mean the Indian markets, and have focused on DIIs. But definitely, FIIs are a big theme. And what the finance minister said in an exclusive interview to NDTV yesterday is important, where she said that Indian markets are resilient against FII shocks in this conversation. And more on that, on what she said, what the data tells us with Alex now.
Absolutely, Tamanna. In fact, let's start this conversation, which is not, I must point out at the start, anything that is new. But then with the latest comments by the finance minister, apologies for that, it puts certain things into context, and we'll show you the data of that. But first, let's listen into what she said to Vasudha Venugopal just a short while back. This is only a slice of that conversation, remember, but it has to do with foreign institutional investors. Listen in.
In general, I think Indian stock market has had less volatility compared to the global markets. And the shift from, let's say, fixed deposit or post office saving to the retail investments, either through mutual funds or demat accounts directly, I think is a healthy trend, because people are now benefiting from the transparent ways in which companies, the listed companies, are disclosing their information. When they disclose the information, people do understand that well-governed companies are up there performing well and they can give good dividends. And as a result, even small investors, irrespective of the risk that the market poses, are coming in on the back of good information flow. It's a good trend. In fact, that has also served as a cushion when FPIs and FIIs flow out of India. There is no huge shock, because these people are there to absorb the shock. It's a good, healthy trend, and it should continue.
Indeed. So it's a trend, and in fact the numbers point to that trend. To talk about this in a little more detail, I've got Muralidhar Swaminathan joining in. Murali, so let's first talk about that data, because it's very stark and it's very clear. What have you picked up? And we're looking at data from April of last year, and it's very powerful.
Yeah, exactly. It's a very powerful trend that we have noticed. This has been there for almost more than a year. You've been tracking this very closely, Alex. But what stood out was the finance minister coming out and making a statement on this, which is very big. It's very rare for a finance minister for a country to come and talk about how domestic investors are cushioning this market. Let me slightly go back to, let's say, from 2000 to say 2000, about 2010, 2014, 15, every time FIs sold, the markets would crash.
Yeah.
So it was seen as hot money. People would say that, look, FIs will come, they will dump, they will go away. So every now and then you would have seen that kind of a trend. And that was because the mutual fund industries and the domestic market had not taken off. So over the last 2-3 years rather, slowly it's picked up. One very important number I will start with, Alex, is that during May, FIs sold roughly 22 to 23,000 crores.
Yeah.
Now, how much did the domestic institution put? Almost double, 41,720 crores. So that shows the might of the domestic institution. Just imagine if the domestic flows had not been there, you would have seen the Nifty going down below 20,000.
Yeah, and in fact, yesterday we hit 23,100. Yes.
Now that is just only one number. That number will come up on your screen. So let me take this to the year 12-month picture or 13-month picture. Since April 2023, FIs put in 2 lakh crores, okay, net of selling and that kind of figure. DIIs, or the domestic institutional investors, put in 2.5 lakh crore, of which mutual funds have put in 2.03 lakh crores, or 2 lakh crores. Bulk of the contribution has come from mutual funds, and the mutual fund investors are retail investors spread across different regions of the country.
So would you say that if you, and I hope that we can pull up the monthly data as well, because we've gone monthly all the way back to April of 2023, and you will notice certain months, Murli pointed out May, where you've seen 23,000 of net selling by foreign institutions. You see January of 2024, where there's a net selling of 25,740 crore rupees, at which time that was matched by domestic institutions. Go back to October of 2023, where you see selling of 24,500 crore rupees. Equally, there were domestic institutions that bought as much as 28,254 crore rupees. Now, I would hazard a guess, and I'm pretty sure that the data will match that, Murli, is that anytime there has been a sell-off, there has been infusion of funds by retail investors through mutual funds and domestic institutions. And so would you say, therefore, that opportunities have been lost by foreign institutions over the course of the last year?
No. So you can interpret two ways. You can say that FIs may have lost opportunities, but they also gave opportunity to the domestic investors to step in. If they had not sold, see, typically what they would focus on stocks with good float in the market, good pedigree, long-term investments. But what they may have missed out is the small and mid caps, where the story is unfolding now. That's where the domestic institution, you know how much money has flown into small caps and mid cap stocks.
Yes.
So that's where I think the ownership of the Indian industry is there. So that gives you a very strong pillar, and that widens the market, as opposed to, let's say, 10 or 15 years back, you would look at only a basket of, say, 50 or 60 stocks. Today, you're looking at a basket of solid 300 to 400 stocks. I mean, if you look at one of the biggest small cap funds, which is about 45,000 crore, which is your Nippon India Mutual Small Cap Fund, it must be having some 120 stocks.
No, much more than that.
Or much more than that.
Yeah.
Now it must be much. So that gives you a very clear picture that people here are discovering stories. Investors are discovering stories. There is more research, and the governance issue, of course, is there for companies, which I think there is a lot of transparency. You know, the regulators have also worked towards that one. But the important point, to come back to your question, maybe now the FIs are missing out on the opportunity. Maybe they stayed out for a little too long.
Okay. To close this conversation, do we say, therefore, that despite the volatility that we've seen in this week and in the last week, do we say that we're more protected on the downside? Would you draw that analogy?
No, that's a little too early to say that, and we should not stick our neck out, because this conversation is not about the upside or downside here. This conversation is that whenever there is a fall, there is cushioning, there is support from the domestic investors, and typically you would know better, every month if SIPs come in, roughly about 20,000 crore or 18,000 crore on an average, the figures for the May month are not there. So if you're looking at 41,000 crore invested so far by domestic institutions in May, it's the money that came in the last month, so the reserves are there. So for May, you will know what kind of monies are going to come. I think that will come in June, and I think there is enough firepower, enough cushioning for the market to withstand any shock coming from FIs.
All right. On that note, we have to slip into a very quick break. On the other side, though, we will talk about the latest cues on the F&O front. So do stay tuned.
Welcome. This is India Market Open. We're taking stock of the futures and options space, which has been very, very choppy. And, you know, every single day we look at the Nifty and we realize that it's closed flat. But what has also come through is an extremely sharp moves on an intraday basis. That's exactly how things panned out yesterday as well. So when you do, in fact, consider the Nifty, let's pull that up on the screen and take a look at the rollovers data. Now, the Nifty, again, marginally in the red, rollover standing at around 36%. As you can see, the change in the respective change in both the May and the June open interests. And while we have seen a little bit more traction coming in through June, and naturally we will also start seeing a lot more positions being built, especially keeping in mind the first week of June. Well, as far as the bank Nifty is concerned, and that's where we have seen a little bit of an outperformance with respect to the Nifty, up around 0.6%. Rolos here standing at around 33%, and we will keep an eye on the monthly contracts that comes through in the day after. Again, we are seeing some amount of traction in June and a lot of positions being built there. But when it comes to the options market, as far as the Nifty is concerned, yesterday was a day where we saw a lot of writing around calls, even as the Nifty came off quite substantially in the last bit of the session, the last 1 hour of session. But as far as your overall open interest is concerned, on the higher end, keeping an eye on 23,500. That's where we have substantial amount of calls written. On the lower end, 22,500 puts. And in the middle, in the center of this range, well, if I can call it that, is a 23,000 call as well as puts being written there. When it comes to the 6th of June expiry as well, the picture is not very different. In fact, identical when it comes to a considerable amount of calls and puts being written around the 23,000 mark. On the higher end, 23,500 calls see a good amount of OI distribution, and it is the same for the 22,500 put on the lower end. Now, today is a Fin Nifty expiry. Again, it is going to be another choppy session. There's going to be no doubt about it. 22,000 calls and puts are where we have seen a substantial amount of OIs open interest coming through. And in terms of, stocks coming down to that, there was a lot of weakness towards the end of the session yesterday, and which is why we saw Balrampur Chini, Z Entertainment, Aurobindo Pharma, and SBI Life, all of them looking at, well, shorts building in. In terms of stocks, we saw unwinding as well, short covering for PNB, GNFC, and Bandhan Bank, Biocon, and Hindustan Copper, see longs unwind. But on that note, let's get in an expert for today. Well, we have Amardev Singh of Angel One who's joining us on the show. Amar, good morning. Thank you so much for joining in. Amar, let's start with your view on Exide. Now, this is where we've seen a lot of traction on the positive end. Are you also constructive, or do you see a bout of perhaps a reversion in terms of mean?
Yeah, so looking at Exide, what we are witnessing in Exide is that this is one stock which has really taken off, and if you look on a quarterly basis, the stock is up by almost 63%, and even on a monthly basis, the stock is doing quite well and is trading at record highs. Looking at the data in terms of the derivative data in terms of the volumes, the stock continues to remain strong and firm. So this is one stock one can look at from a short-term perspective. And for that, one can look at the June 540 call option for the next month series, and with a stop loss of 12 and a target of 48 in the short term. So this is one stock one can definitely look at.
Okay. So this is the June expiry, which means that it leaves you with a good amount of traction. Firstly, that the time decay will not be as much, especially earlier on in the series. And of course, it also gives you an advantage. Should we see an increase, a further increase in volatility, that will also mean that option premiums could rise. And based on that, we could in fact see the rise in the premium of the call only by virtue of the rise in volatility. That said, of course, we are also waiting on a sharp move very immediately, which would actually give you a sharp fillip as far as this particular call is concerned. But Amar, moving on, the other one which is on your radar is Glenmark as well. This is where we've seen a good strength coming through. What's your view here?
Yeah, if you look at Glenmark Pharma, if you look at the entire pharma space, the pharma space has been, I would say, buzzing of late, and most of the pharma stocks, be it Divi's Laboratories, be it Aurobindo Pharma, be it Glenmark Pharma, be it Biocon also, which was lagging now, that's also started moving up. So the pharma space overall, we are seeing a lot of interest, and Glenmark Pharma is one that stands out because the stock is very strong on the long-term charts, intermediate-term trend, short-term also. We are seeing some very significant move, and we've seen some decent volumes also happening in this particular stock. The derivative data also points towards a further upside move. So this is the next stock one can look at. Here one can look at buying the June futures at the current levels or any dip towards 1100 levels, and with a stop loss of 1043 and a target of 1235 in the short term.
Okay, and that's as far as Glenmark is concerned. Amar, on that note, taking a moment to thank you for joining us and giving us those 2 calls that we can keep an eye on. Well, with that, it's back to you.
Thank you for that, Agam. Let's get Rajat Bose in. He's SEBI-registered research analyst. Rajat, very good morning to you. The question really is, what is the extent of volatility we can expect in the markets today and over the next few days till the June 4th event? We saw that come in at close yesterday. Let's start with your take on that and where you see the indices going.
Well, you see, if you look at the volatility index itself, that has also moved up. But prior to that, good morning to all of you. Thank you for having me. Coming back to volatility index, look at it, that it has gone up 6.83% yesterday. Volatility is rising, and there is some degree of nervousness among traders that I can sense. And one of the major problems is that most of the stocks that you want to buy, say say stock like Glenmark Pharma, that is actually on a sky-high situation. It can move up further, but then the problem is that the market is already highly, highly overbought. And whatever you try to buy, whatever you think of considering to buy, unless you are buying for very long term or very short term, you are a very nimble-footed trader, you can't actually buy. That's the problem. On the other hand, if I have to give an honest kind of advice for stock trading, or I would say it's time you book profits wherever you have large gains, at least partly, wherever you can see that there can be a possibility of a more than 10% downside, because otherwise your long-term capital gains will not be nullified when you rebuy it, when you repurchase it. The point here is that from 23,000 levels, we can go to 23,150, 23,200. If we cross that, at the most 23,700, something of that kind. And if you have a 400 par, then 24,100 to about 24,700. But even in that extreme situation, the best possible situation for the market, even then, after we reach those levels, there will be a substantial correction. That's what I foresee. That's what I see on the charts. Most of the charts are showing that there is going to be a correction.
When? Rajat, the billion-dollar question is when? Post the 4th June event? And you know, I just want to bring in here that one correction is due in the market is something that we've been hearing for the last several months.
Yeah, correction is overdue, that is there. But there is, now that we have invested so much in this particular event, that is election and its outcome, and the kind of expectation the market has, given that, you can say that whatever happens, see, why is this rise? The rise is because that we are trying to discount the positive thing that is going to happen. And once the thing has happened, after that, people would come to book profits. See, a bull market gets halted when bulls stop buying. And we have reached a situation that there would be a stoppage of buying and profit booking coming in. Do not get into the argument that the bears will pounce on. Bears are not in a position to pounce on. It will be lack of buying that will see a correction. That's the kind of scenario. And this is the last chance for some people to book profits. I would suggest that unless you are holding a stock for very long term, 5 years or more, if your horizon is not that, then I think it's time you booked profits. Partly, you have 4 more sessions, including today's. Don't try to get into that 3rd of June, what will happen. 3rd of June, exit polls and a lot of other things, discounting would start happening. So this is your chance to actually get out of certain stocks which have gone up so much and you have made a lot of money. This is still a notional profit.
Yeah, so, I think word of caution, note of caution there from Rajat. What are your calls for today, though?
I would suggest short-term buying because, see, whatever perspective I've given you just now, that is for medium to long-term kind of players. Short-term players can still, especially the scalpers and very short-term players, I would recommend Godrej CP, Godrej Consumer Products. The stop loss will be 13.12 and targets would be 13.45, 13.60 and 13.70. This stock is actually showing a lot of traction in the sense that it has posted a high around 13.75 and it has come down. It is now forming a small saucer pattern, and that saucer pattern completion will happen when it goes between 13.60 and 13.75, and the 9-day moving average is supporting it. The other stock that I'm going to recommend is Escorts. Escorts also, it has shown up flag formation, blue list flag formation. It's closed at 38.55. You buy it with a stop below 37.98, and on the upside you have 39.58 and 4,005. All I'm saying is that it might reclaim the earlier highs posted a few days back. I'm not projecting any very big rise from here. That's why it's a short-term recommendation. But one thing, it has never broken the 9-day exponential moving average, that is Escorts. So its uptrend is still intact and there is still some money to be made.
Okay. Watch out for those ideas. Rajat, I'll come back to you. Interesting thoughts there. But let's also try and look at some of the other stocks which might be active today on the back of fundamental reasons, earnings, what have you. Mihika Johnson with a list of, Mihika, some of the key earnings today?
Yes, up first on my list is AstraZeneca Pharma. Now, revenue is up 34% on a year-on-year basis. However, EBITDA and margins did see a contraction, but net profit was up 2.2 times. However, the higher net profit was of a lower base because last year saw an exceptional loss item, and the 810 basis point margin contraction was on the back of higher raw material costs. Now, just for some perspective, raw material costs as a percentage of revenue this quarter stood at 56% versus 34% a year ago. And additionally, the selling marketing and distribution expenses were up 53% on a year-on-year basis. Next on my list is Sumitomo Chemical India. Now, it beat estimates on all fronts. Revenue was muted up 3.5%. However, EBITDA saw an 840 margins saw an 840 basis point expansion, and net profit was up 52%. Now, the margin growth was supported by lower cost materials for this company. Changes in inventory, the item was down 70%, and raw materials as a percentage of the total revenue was at 59% versus 69% a year ago. And last on my list is LG Equipments. Now, revenue, EBITDA and profit missed estimates. The revenue growth was up 3.6%, and this was impacted. The growth was impacted because of the air compressor segment, which only saw a 3% uptick. But there was support from the automotive equipment revenue segment, which is up 8%. But this, as a percentage of its revenue mix, stands much lower than the air compressors business. EBITDA was down 1.7%, and margins did contract. And in the end, net profit was down 55% for the company on a year-on-year basis.
Okay. Mihika, thanks for that. So some interesting names to watch out for. Sunny Agarwal, Head of Fundamental Equity Research at SBI Cap Securities, joins us as well. Sunny, good having you. Thanks for joining in. I want to start off, Sunny, with some of the results. We'll also discuss, by the way, some of the stocks on which there are some block deals lined up today. Would love to understand your views there. But let's start off with the results. Commodity names, both NALCO as well as NMDC. What did you make of the numbers? Because in NALCO's case in particular, while the margin uptick has been very strong, the PAT boost is also because of a royalty reversal. So one, are there one-offs here which might cap the upsides for NALCO? Or are you enthused by this 1,000 basis point uptick YOY in margins? And if that continues, what could happen to profitability?
Yeah, good morning, Niraj, and good morning, everyone. I think our numbers are pretty robust as far as NALCO is concerned. And we all know that market is always forward-looking. And the way aluminum prices are shaping up globally, I think even the first quarter, that is the June quarter number, should be pretty robust as far as any commodity processor or mining company is concerned. But having said that, I think in terms of valuation, I was just checking the valuation list right now, trading close to 10 to 11 times EV to EBITDA multiple, which I feel is very in a kind of fair value band as far as valuation is concerned. So maybe today a kind of a positive reaction we may see as far as Nalco is concerned. And then probably if somebody want to deploy fresh capital in Nalco, maybe buy on dip is the right strategy at the current juncture. We have already seen a big run up across all the commodity basket. So we continue to remain bullish on entire metal as a space basis that globally there is a strong uptrend in the commodity prices. And that will lead to a earning boost for all these companies in FY25.
Okay. Just one quick follow-up there on NMDC. Sunny, very quickly, iron ore prices have bumped up a bit as well. The numbers seemed okay. Constructive here?
Yeah, so for NMDC, there was one-off in the base quarter, that is in the fourth quarter FY23, and that is the reason it may appear that on a YOY basis, NMDC number are not good, looking very attractive. However, on Q1Q basis, I think there is still a lot of improvement on NMDC front. I think again here also what I feel is right now post the recent run up, the stock is trading again close to 10 to 12 times EV EBITDA multiple, which is in the fair value band. So here also the same strategy of Nalco should be adopted. Buy on dip is the right strategy till the time commodity prices, especially iron ore, is in strong uptrend.
Okay. Stay on, German. Let's focus a little bit on FMCG as well, because the monsoon forecasts have okay, maybe not turned, but are constructive right now. Does that aid a little bit of firepower for the sentiment around FMCG and staple names and consumption? Shirish Pardeshi from Centrum with us on that for a quick perspective there. Shirish, good having you. Thanks for joining in. Is there a one-on-one correlation, you reckon, between what could happen to consumption names per se and the probability of a normal monsoon or the forecast of a normal monsoon?
I think there are two things which comes to my mind, and if you look back last 2.5, 3 years, the monsoon has been becoming a key important event. And unlike last year, we had a El Nino effect and we had a stretch condition, though at the fag end the monsoon was normal. What is more important is that at this point of time, the inflation is one of the important factor which is reeling or cutting the consumption in the rural markets. Suffice to say that the earning income and the activity is also taking a little backseat. So at this point of time, this positive sentiment with the monsoon coming up will obviously create some cheer, and I think these positive sentiments will also drive to a certain extent the consumption. Second important factor is that once you have the monsoon visibility, the farming activities will take up a speed. I think that is more important because if you don't have a visibility on monsoon and the timelines, I think the farm activities will have a dispersion in its sequence. So I think if I read at this point of time, both the agencies has given a positive. Those Skymet is predicting 102% better than the normal average. I think these two things will definitely have the impact on consumption. Why I'm saying so? I think last 5 to 6 quarters, the whole FMCG pack has been struggling. And when you actually look at the syndicated data from Nielsen and other agencies, last 2 quarters, I think the negative has slightly become positive. And I think if you pick up the last quarter commentary from most of the FMCG companies, the rural growth is slightly ahead of the urban growth. And I think these all things will have a positive impact on the company's performance and obviously the consumption on rural.
Niraj, hi, morning, Tamanna here. Just to take that point forward, and yes, the Nielsen data also shows that rural growth is on the verge of a turnaround. A lot of commentary from companies in the FMCG space is pointing to it as well. So the monsoon forecast that we've been seeing, we're probably going to have above normal rainfall. probably on time. That's very positive. What is the kind of impact you see on consumption and then on profitability for these companies?
See, I'll answer the profitability part first. I think it is too early to talk about profitability part because what you have to keep in mind sequentially, there is a price adjustment which is happening because of the lower raw material prices. So you can say that part of the benefit, most of the companies has parted away with the consumers. Second, I think unlike COVID period, the companies also expanded its advertising budget. So most of the companies would have increased their ad spend about 200 to 300 basis points. So I don't think in the near term you will have an impact on profitability going up. Maybe defending the profitability would be a challenge for most of the FMCG companies. To talk about the revenue growth momentum, I would say that the volume growth is the key. And once this demand normalizes, you also have the base effect which is going to kick in. So I would expect that most of the companies would do mid to high single digit volume growth. That is more important and that's the key to watch for the most of the companies' performance.
In terms of specifics, let's talk a bit about ITC, Shirish, because while you had, I think, the likes of Nestle, HUL, even CP, Colgate-Palmolive react positively and the numbers looking fairly good, ITC was a bit of a dampener. And now this whole question about the value of its hotels business, questions raised about, if the demerger helps shareholders or not. I wanted you to weigh in on what you made of ITC's numbers.
See, I don't think there is any problem with ITC numbers. I think what you have to keep in mind is that the agri business has cut its growth momentum primarily because there is the export factor which is limited. And if you nullify that business, I think the growth is normalized. Second one, what you have to also make out the FMCG business or cigarette business, I think the cigarette business also has the factor that there is no price changes which has happened in last 2.5, 3 years, primarily because of the inflation, which has started subsiding. But I would expect that the growth will be largely led by volume. And similarly, on the FMCG part of the business, the 7.2% growth, what they have reported, if you look at 3 years CAGR, the growth is still stronger. What it means that going forward, the FMCG business is going to be primarily driven by the food. And I would expect that the food categories are doing much better than the personal care categories at this time.
All right. Thank you so much, Shirish, for speaking with us. That's a great view on what is happening in the FMCG space, especially now that it looks like monsoons are going to be on track. Whether it converts to profitability or not is too early to tell, says Shirish Pardeshi of Centrum Broking. We'll take a very short break, but we'll be right back with pre-open rates and, of course, what should be your top calls for the day. Stay tuned.
Welcome back. You're watching India Market Open. We're gearing up for another volatile session of trade, and a start around 23,000 is what's expected. The bulls and bears will battle it out in today's day of trade as well. Remember, the VIX has jumped substantially, par for the course as we get closer to that fourth event outcome. Rajat, what are you doing with banks? There is an expectation that if the bank Nifty does a conclusive close above 48,600, 50,000 is in line of sight. Constructive on Bank Nifty at these levels? Fresh longs could be initiated?
Regarding banks, what you can do is that you need to see whether yesterday's high, that is 49,688, 49,688, that was a resistance level. I mean, 49,700 to about, say, 50,000. This will be a major supply zone. If this supply zone is taken out, then you can expect further upswing. But the problem is that one stock that is someday it performs, someday it doesn't. That is HDFC Bank. And HDFC Bank, I'm not liking it much. It is not going to get past the 1550 mark and sustain there, even if it were to do so, because there is now. There was a time when HDFC Bank was, you can buy, you could have bought it eyes closed. No longer that is the scenario. There are lots of naysayers. There is a lot of skepticism. So the major driver in the Bank Nifty is not doing its job. But you can look at things, look at stocks like Punjab National Bank, look at Canada Bank. These stocks are doing well, and among the biggies, I would say you can go for Axis Bank and ICICI Bank among the private sector banks. These are looking good. You can get into that and take this opportunity. If HDFC Bank moves up, at least you book your profits, reduce your exposure there.
Right. Sunny, HDFC and Kotak have sort of lost their premium while ICICI Bank has earned it. How tough is it, in your opinion, for ICICI Bank to retain the crown as far as valuations are concerned? Because technically this is one pick which is unanimous across the board for analysts.
Yeah, I think valuation de-rating and re-rating is obviously the function of earning growth and strong visibility. So I think as we speak, I think the visibility continue to remain robust for ICICI Bank and as well as Axis Bank. And what we feel is that the premium valuation which ICICI Bank is commanding as compared to HDFC and Kotak, it will continue to remain at the current juncture. However, it may happen that once we start seeing a performance improvement from HDFC Bank, there may be a valuation catch-up by HDFC Bank over the period of next 3 to 4 quarters. So that may be the possibility. But I don't think there is any probability of de-rating of ICICI Bank because of the improvement in the performance of HDFC or Kotak.
Okay. Remember, there are 3 or 4 block deals slated today. There is Concord Biotech, there is Inox Wind, there is Timken, and there is also maybe PB Fintech. So 3 or 4 names on which there are block deals likely today, and Inox Wind is the 4th one, and all of these should be kept in mind. Rajat, good morning. On the charts, any of these that you've seen, Inox Wind was down yesterday, even as its parent Inox Wind Energy was up 5%, but there is also Concord and Timken.
Inox actually, it did show a lot of bullish fervor yesterday, at least in the initial stages and later on also, but ultimately it closed near the day's low. So this has actually given a negative signal that at least even if you don't short it or something, short you can't because it's not there in the FNO segment so far as I remember. But you should wait to buy around, say, 150, 146, because Inox showed that there is a breakout failure. At least yesterday that was the case. If it were to go above 177, then you will get a good opportunity.
Right, that's Inox Wind. What are you doing with pharma this morning, Rajat? Anything in the pharma pack that looks good on the charts for fresh longs to be initiated?
Well, Glenmark looks pretty good. And there has been the stock that was also pretty good, that was DV's. First, Glenmark. Glenmark is showing a clear breakout, record volume for the last couple of months, I would say. And it has shown a range breakout. So Glenmark Pharma, either at current levels or on any dip you can buy, provided it doesn't close below 1050 again. In that case, you have to exit this position. And regarding DVs, I would say I'm not giving any recommendation because I personally hold the stock, and if I give a recommendation, my hands will be tied for the next 5 trading days. So what I would say is that, yes, it is looking great. If it crosses 43.50, then it would be even better. And if it falls again below 4050, DVs will get into that consolidation mode that it was already there.
Rajat, I don't know if this ties your hands as well, but what about Natco? Natco doing well this morning in the pre-open session, at least, after their numbers.
Natco Pharma, you mean?
Yes.
Okay. Natco Pharma, if it manages to get past the level of, say, 1050 and stay there, then definitely there is a trading opportunity. Otherwise, a marginal movement on the upside till about 1050, it will meet with fresh selling pressure, because yesterday it opened close to about 1050 and then started coming down. So this is not a good sign. So if today it were to move up again, it needs to take out the 1050, 1055 supply zone. Only then it becomes a technical buy.
All right, so it's a technical buy. Natco looking like it's set for a very good morning, at least in the pre-open session, up about 8%. Now, a slew of brokerage notes also in focus. Mahima joins us with the top picks this morning. Yes, Mahima?
Right, Tamanna, so I'll start with Nuvama, which is downgraded Century Ply to reduce from hold and has given a target price of 582 versus a target price of 716, so the downgrade is around 11%. They've said that strong volume growth in MDF, however, laminates were below their estimates. They expect double-digit top-line growth in terms, 10% in terms of plywood, 20% in laminates, and robust 40% growth in MDF going forward. They've said that growth was supported by capacity addition across segments, and they've said that elevated timber cost continues, which is a concern, and they've said that pain is likely to continue in MDF because of the elevated timber costs as well. They're saying that capex is on track, however BIS norm implementation will be a key thing to watch out for, and they're cutting FY 25 and 26 estimates EPS sharp by 20% and 24% respectively, and overall valuations is based on 28 times the FY 26 estimates EPS. The next one is Jefferies, which has maintained a hold on JK Lakshmi with a target price of 905 versus 940 earlier, which is an upside of around 13%. Q4 EBITDA was a beat driven by lower costs. Volumes are weak, however realizations are in line for JK Cement. The company delivered second quarter of 1000 unit plus EBITDA, but the volume growth, as I mentioned earlier, was weak. The company is scaling up capex right now at 12 to 1600 crore versus 300 to 1000 crores in the last decade, and they've tweaked FY 25 and 26 estimates by 1 to 2%, reflecting the pressure that is there on the cement industry as present. So these are the two topics, brokerages for the day.
Thanks Mahima for that. So watch out for that. Now 908, as the pre-open rates have settled down, wonder if the likes of Natco Pharma, Sumitomo Chemicals, etc. are doing well. Natco is up 7%, very strong move there. Sumitomo up about 4%, pretty decent there too. And the likes of GMDC might be reacting negatively. The one that maybe unsure of is AstraZeneca, wherein the margins took a sharp plunge, but because of a base effect, that stock did the profit number looked okay, flattish currently. The other pieces, the last 3 days, HDFC Bank has been the top point contributor to the Nifty move. And if you just look at what the FI action is, wherein there is a fair degree of covering both on the index and on stock futures, as well as long build-up that is happening, maybe that wouldn't surprise you that that such a thing is happening. Remember, FIs have built up serious long positions on the index futures as well as the stock futures. So that data is very interesting, and we should pull up that data, by the way, while we are doing that. But Rajat, would love to know your view. After 3 days of a strong movement, is HDFC Bank ripe for a corrective move, or would you stay long here?
If it crosses 1548 and sustains above that, then there is definitely technical, it's a technical pointer for you to remain long. Otherwise, if it fails to do so, yesterday it showed a inverted hammer line. That is a negative signal that suggests that at higher levels, it is experiencing quite a bit of selling pressure and it can come down. But so long as it doesn't come down below, say, 1497, that is its 9-day exponential moving average, it won't be that weak. And a little earlier, I said that if you get a rally in HDFC Bank, you can at least book part profits, because at higher levels, continuously, I see selling coming in.
Okay. And remember, viewers, one of the reasons why this is, of course, happening is because of the kind of long positions that are being created. Not only have FIs created $1.43 billion worth of long index futures in the last 3 days, but on the stock side as well, they've added about 1.78 billions worth of long stock futures and covered some of the short stock futures as well. When such an action happens, you know that the heavyweights like HDFC Bank, 14% weightage on the index, or a Reliance, etc., arguably usually do well. One of the reasons possibly why HDFC Bank has been the top point contributor.
Talking about banks, I think LIC might have it quite pleasant this morning. If you can quickly pull up that stock in pre-open trade and see what it's getting up to. A couple of brokerages are quite constructive on LIC and expect a medium-term uptick of about 30% in terms of stock price. But Rajat and Sunny, I'll come to both of you. But Sunny, maybe you want to go first on this one. What did you make of LIC's earnings? Profits have grown even though they've sold lesser policies. And they've been grappling with holding on to their market share, which they've been successful at least so far. On LIC, what's the verdict?
I think if you look at the internal numbers, I think the increasing share of non-participating products. So FY23, the share of non-participating product was close to 9.5%. FY24, that has increased to close to 18%, and that's a high margin product. So I think that gives a lot of comfort, at least in terms of margin trajectory. VNB margin continue to remain robust, especially on individual portfolio. And the kind of product launches which we are seeing in non-participating product, I believe that this trend of increasing share of non-participating products should continue for FY25 also. Coming to valuation, embedded value for FY24 is close to 7.25 trillion rupees, and market cap right now is hovering close to 6.5 trillion rupees, trading at less than one price to embedded value. I think there is at least there is an upside till one time price to embedded value. I think 15 to 20% upside can be easily seen in terms of as far as valuation catch-up is concerned over the period of next 6 to 12 months.
Rajat, I wanted to get your view on Cochin Shipyard. At the start of our conversation this morning, you talked about how people should look at their portfolio, and if there have been huge gains, exit. This might be the last chance. Would Cochin Shipyard be on that list? Again, looking like it's going to be set for a good day.
I wish I could show you the weekly chart of Cochin Shipyard. It's a flat from 2019 to 2023, and after that the parabolic rise has started. It is looking like Changabang west face on the Himalayas. That's a steep climb up, 7,000 feet, that kind of a thing that is being seen in Cochin Shipyard. And the latest, the kind of movement that you have seen yesterday, maybe the first sign of profit taking. I'm saying profit taking because the volume was also pretty good yesterday. And before that, there was a seesaw movement on the day before, that is on Friday. So Cochin Shipyard, if you are in the money in a big way, then definitely at least book part profits. I'm not saying that just because it has become parabolic, it cannot rise further. It can, but all these, if you look at the history of DVs, history of Dixon at one point of time, and then the kind of corrections they have given over the past few years, then you would definitely appreciate what I'm saying about Cochin refineries. And there are lots of parabolic rise stocks in the market at the moment. Most of the PSUs, you will find that similar kind of situation is there.
Well, parabolic is the way to put it for Cochin Shipyard, for a BVL, for GRSC, what have you. A clutch of these stocks have done well. By the way, a lot of stocks have done well. With markets at new highs, obviously something like this would happen. But as the pre-open rates have settled, we're not looking at a weakish start. It's not bad. So kind of building on from where we left off last week, even if we ignore yesterday. The only point is, will specific stocks, and a lot of newsmakers today, not large caps but mid caps, and therefore they'll be in focus. Certainly keep an eye out for some of those. But here come the first rates this Tuesday morning. Remember, a week from now at this time, we'll be looking at the leads that are coming out from the Indian elections. But for now, we contend with the Nifty, 40 points higher. Not a bad start, you have to say. The mid, just about okay actually. Bank Nifty about 0.14%. The mid caps and the small caps at about a 0.25% for the mid cap space, about 1/3% for the small cap space as well. Not a bad start for the broader end of the spectrum. Bring up the heat map and show you what's moving and what's not. Let's start with the gainers, because a clutch of gainers there. Hindalco's movements suggest that there might be activity in Nalco as well. Watch out. Remember, metals per se have seen a bit of an uptick in the recent past. NTPC about 0.78%. Wipro, yesterday's key loser because of the Sensex shun, is bouncing back a little bit. Reliance Industries is participating. For a change, I don't see HDFC Bank in the top 10 or maybe even top 15 or top 20 either. So that's the other interesting piece. TCS, LTI Mindtree, IndusInd, Adani Enterprises are some of the others that are out there in the list of the greens. What is losing out? Not too much. Maybe a bit of a pullback for autos, because Bajaj Auto, Maruti, Hero and Eicher, all four in the list of the losers. But that's symbolic. I think the only one making its presence felt is Hindalco, and 3 days on a trot now. Hindalco has had a really good run, frankly. Just before I hand it over to Tamanna, can we pull up the 3-day or the 5-day chart of Hindalco, because you will see, let's put the 1 week chart of Hindalco. You will see some serious up moves in the last 3 days post the results of Hindalco. I think it's done really well and definitely worth a mention here. Look at this pullback from these lows to now, trading about 3 or 4% higher, 689 and counting. Tamanna, not as much activity in large caps, unfortunately.
Not too much activity, but not too negative either, I would say. Right now, 3-4 days before an election, that's not bad news. Any news which is not bad is good at this point, I suppose. Your mid-cap stocks also doing okay, holding on in the green. Let's pull up the small cap index. Pretty much flat. A lot of result action this morning, and let's just pull up those key numbers. We're at the fag end of the result season. What is the impact? LIC, one of them, numbers better than expected, completely flat. Nalco and Natco really are the stars this morning. Both a very robust set of numbers. Natco Pharma doing well, 5.5% up, so is Nalco. So in an otherwise pretty volatile, range-bound kind of a start to the trading day, these two are doing not too badly. AstraZeneca is something I wanted to pull up as well. We talked about how the numbers were fairly decent. The response is quite flat. Sumitomo Chemicals in that category as well, but Sumitomo is being rewarded by the street. Century Ply had a couple of notes out this morning, including a downgrade from Nuvama. The stock is flat, not reacting too much. I wanted to pull up ZF commercial vehicles. Now, ZF.com was on a 20% socket up yesterday. It saw some profit booking in the pre-open session, but it's an interesting open that we're seeing for it. So the company is partnered with IIT Madras to build a global mobility digital infrastructure setup. I thought that was quite interesting. So 2% up on ZF.com. Cochin Shipyard, I wanted to talk about, because how far can it go? And yes, as expected, you're seeing a bit of profit booking coming in on Cochin Shipyard after the breathless run-up that it has seen so far. And, this was what Rajat Bose was also recommending this morning, that if you've seen a huge bump up on your portfolio, maybe it's time to take some off the table. So, Samina, some spots of green, but I wouldn't say too much activity this morning.
Tamanna, what stands out for me this morning is it's the first morning after many days that BDL is actually trading lower. So this we haven't seen on the screen for nearly 15 odd trading days. The stock for the very first morning is actually seeing a downtick, down about 3% odd. Couple of block deals could have potentially hit in the last couple of minutes. So let's pull up those stocks because those are reacting in trade. Inox Wind, it's 8% lower. Concord Biotech is also seeing a negative reaction, 8.5% on Inox Wind. Concord Biotech is down 3.5%. Timken India, on the other hand, is seeing an up move. That's the movement, 4% higher is what we have. Arvind Fashion, 7% lower on the counter. AGI Greenpack, 4% lower. So there's a lot more red and profit taking as opposed to buying that we are seeing in trade this morning. A couple of other earnings reaction that I want to quickly go through before we move on and talk about other movers. Vishnu Prakash was up 8% yesterday, continues its upward journey, has a pleasant start to trade this morning. 6% higher is what we have on that one. Jubilant Industries, SH Kelkar, these were earnings that were better than what the street was expecting, and the market is appreciating that. 4% on Jubilant, SH Kelkar up 2.5% to 3%. On the sell side, I'd imagine Borosil Renewables, LG, Automotive Axles. These are companies that reported disappointing earnings. So Borosil Renewable is down 4%. Dish TV is the other one, but LG Equipment is also down 5% in trade on weak earnings. Automotive Axles, if we can pull that one up too, that's down 2%. And Dish TV seeing a 1% cut in trade. Those are earnings that were weak. GMDC, Lumax Autotech, Garvare Tech are some of the other ones that you want to track this morning. GMDC is down 3% in trade. Along with that, you've also got Lumax Auto. If I can pull that one up, we should get a sense of what the reaction is. Marginally high is what we have. RR Cable is having a good morning. It's up 4%. Capital Market Play is back in action. And Nuvama is trading firm, 4.5% up move. Arvind is up 9%. I think that turns out to be the stock of the morning in the broader marketplace with a 9% uptick. Started off semi-flat, but has picked up as we've gone along in terms of trade. Torrent Power. So power is seeming like quite a theme this morning. Up 4% on Torrent Power is what we have. Sumitomo Chemicals, I think Tamanna mentioned that, is up 5.5%. So building on those gains as we see it. Sterling and Wilson is up 3%. United Spirits posted strong numbers yesterday. The counter continues to gain. It's not just Nuvama, but 360 and JM Financial are also looking fairly well placed in early minutes of trade. Indus Tower is up 2%. Max Financial is up 1.5%. Some of your select banks are also looking pretty good. On the sell side, it's the block deals and earnings that are seeing a reaction in terms of trade. And BDL is seeing a cut now of 3.5%. Actually, Rajat, you talked to Tamanna about Cochin Shipyard. In the same breath, you've got Garden Reach, Mazgaon Docks, BDL, HAL, to name a few, that have had a phenomenal run. I think after the last 10-12 trading days, BDL is taking a break this morning. I haven't seen a negative start on that stock in the last few days. Do you feel like it's now time to take profits of BDL, or today's weakness could be a buying opportunity for a short-term trader?
Which is the stock, if you could repeat?
Dynamics.
Sorry?
Bharat Dynamics.
Oh, BDL. Okay. BDL, the chart is, again, it's this time it is not just parabolic. There is a very steep upswing that has happened. Now it is on a correction mode. Even if a medium-term investor is holding it, 1350 should be the stop loss. This correction is still a correction. There is nothing to worry much about its movement. But if it were to fall below 1300, then there could be some serious selling that can happen.
Some serious selling could potentially happen, but the broader markets this morning aren't doing too badly. Auto is seeing some weakness, but the mid-cap and the small-cap index is seeing some buying. Pharma is in a sweet spot as well. As we see it, real estate is seeing a little bit of a cut. A couple of those big deals is what, large trades is what's impacting counters as well in trade. Capcodes is also having a relatively positive start. So it's going to be a morning where trade will be volatile. A quick check on the VIX. Let's do a check on how that's doing. It was trading at record levels that we've seen in the last 2 years. A 6.5% jump is what we had seen on the VIX, continues to harden this morning, up about 0.5%. Sunny, anything that you are looking to buy at this, in this market where you're seeing some value?
I think we are bullish on mid-cap company known as Tamanna Rail and Engineering Limited. It's basically play on railway wagon. So we have seen a very robust set of numbers for Q4, and at the same time looking at a order book of 8,000 crore, which is almost 2.5 times FY24 sales, 14,000 wagon in terms of delivery. Majority of the order book is likely to get executed in FY25. So we are expecting 40 to 50% jump in top line, and at the same time, EBITDA margin will sustain in the band of 7.5%. So I think Tamanna Rail is the one company would like to bet on logistic or railway sector. Another company, what we feel is that post extra dividend by RBI to the government, the cool-off in bond yield, the cost of fund for NBFC is likely to reduce significantly. And hence, we have picked Aditya Birla Capital. So the company has done phenomenally well during FY24, lending book growing by 30% year over year. And we expect that this growth in lending portfolio will continue at 25 to 30% CAGR for FY25 and 26 period. Based on at the same time, their AMC business has turned around. We have seen they have gained their mojo back and trying to gain their market, trying to up their market share in terms of incremental SIP flow. So on a sum of the parts value or basis, we feel the fair value of the Aditya Birla Capital is 280 to 300 rupees per share. And that's offer a significant upside from the current market price of 225 to 30 million. So this Aditya Birla Capital is another pick from diversified financial space.
You know, the other spot which is really having a good morning is metals. Pull up Hindustan Zinc. Again, recovery after being beaten down in the last couple of sessions, 5.5% up. Nalco, of course, good numbers, but overall, all metals are doing well. Hindalco, something that Niraj was pointing out at opening, also having quite a good morning. The Hindustan Copper, Vedanta, the entire pack really. Sunny, just wanted to get a quick take from you on metals. Is it sort of, I would say, a safe space right now?
I think the relatively safer bet here will be obviously Vedanta, because here you get to play both Vedanta as well as Hindustan Zinc, and at the same time you get to play multiple commodities like zinc, lead, silver. So all in one, I think Vedanta. So our fair value for Vedanta is close to 550 to 600 rupees band, assuming that the current prices of all the metal global commodities will sustain at a current level. So based on that, I think Vedanta is a relatively safer bet within the metal space.
Yes, it's very interesting how Vedanta has suddenly become the cynosure of all eyes after being shunned for so long, with reason, of course, but I'm just saying this, that it's turned out very well. Sunny, just one quick question on chemical stocks. Sumitomo is a case in point today, but I think we've seen briefly good commentary from a clutch of others. From the names that have come out thus far, which chemical name has impressed you the most, either in terms of delivery of results or in terms of commentary?
I think, Niraj, again, we would again like to be in a wait and watch mode as far as chemicals are concerned, because we still feel that it's a very early to get into the trade as far as chemicals are concerned. But having said that, we would like to bet our money on if somebody is a long-term investor and would like to accumulate stock with an expectation of that 6 months down the line, all these companies will start performing. SRF definitely a street favorite, and again play on basically global the way heat is panning out and the demand for air conditioning is panning out globally. I think SRF is the one stock we would like to bet on in terms of chemical space. Vinati Organic, although a big underperformer during the last 2 years, but I think a very niche product which Vinati is operating in, I feel somewhere 6 months down the line, we may see an improvement in performance for Vinati also, and would like to stick with Vinati Organic and would like to accumulate through staggered buying, maybe over the period of next 6 months through SIP route. Both these companies can be accumulated in a long-term portfolio.
Right. Well, thank you. Thank you, Rajat. Thank you, Sunny, for joining us this morning. The markets are having a bit of a quiet start in trade. No surprises there, given that there is a little bit of volatility in the street. And it's also F1 expiry week, so that is what's going to keep the markets on tender hooks and fairly nimble at this stage. Sub 23,000 on the index, 0.2% gains is what we have. We'll take a break. We'll come back. We'll put the focus on Kolte Patil. They reported numbers. We'll get a sense of what FY25 looks like for the company, so stay tuned.
Welcome back. We're talking about Kolte Patil developers and their numbers this morning. So the figure for FY24 is showing a drop in revenue, EBITDA down 73%, net loss at 67 crores versus a profit of 113 crores last year. In terms of the quarter, the consolidated numbers also showing a revenue down of 34%, EBITDA loss of 18 crores and a net loss of 26 crores. The commentary of the management, though, quite positive for the road ahead. And to speak more on that, Rahul Tadere, Group CEO of Kolte Patil Developers, joins me now. Rahul, welcome and thank you for speaking with us here at NDTV Profit. Let's just go through the numbers, the full year and the quarter, and get a sense of why we are seeing this hit on EBITDA and on revenues.
If you see in real estate, the pre-sales numbers are getting reflected into revenue once the project gets delivered. So whatever the numbers are visible in this the concluded financial years. So this sale has happened around 3-4 years back. At that time, the company's per square foot realization was low, and out of that, the few historically, the legacy project wherein the low margins were there is getting delivered now, and hence getting reflected into revenue numbers. So from that perspective, and there were some financial provisioning for our strategic, the funding partners. So because of that, because of such exceptional items, the margins are looking negative. But we are confident of achieving a good margins. I mean, early teens to late teens in the upcoming and next financial year. I mean, there are a couple of reasons I would like to highlight. See, what are the pre-sales that we have achieved in FY23 and FY24? So if you multiply by business margin numbers at project level business, according to project level business plan, so it is 18% EBITDA, embedded sales EBITDA numbers in FY23 and around 26% of embedded sales EBITDA numbers for FY24. So eventually these numbers will get reflected into revenue recognition going forward, FY26 onwards. Hence we are confident of positive good late teens numbers of EBITDA in FY26 onwards. So in terms of
what is FY25 looking like in that case? You're saying you have a mid-teen positive EBITDA margin in FY26 onwards. What is FY25 looking like in terms of your EBITDA margin?
FY25 from revenue recognition perspective, the margins will be early teens, and FY26 it will be late teens.
Okay, and what was the current margin picture, and did you see an impact there on cost of raw materials, or is this just sort of the pre-sales value recognition that you are looking at playing out?
So for a simplicity of understanding, see, whatever the business, according to the business plans, the margins have been frozen. So we are selling beyond our business plan numbers. So APR realization is much improved as compared to our business plan numbers. And likewise, all our cost expenses are within the budgeted cost. Hence, there is a probability of margin improvement going forward beyond the numbers that whatever I'm quoting currently.
Can I ask you a question, Mr. Tadere, on pre-sales value? And this is not just about Kolte Patil developers. This is, I think, for the entire space. Pre-sales value is what the street is looking at. This is what companies talk about. My only question mark with pre-sales value is how much of it actually converts, right? These are booking amounts, isn't it?
That's correct. See,
so it might be that customer who's booking that apartment may not follow through. Does that happen? Can you give us a sense there?
Yes, industry-wide, this cancellation ratio is around anywhere between 10 to 20%. But when it comes to Kolte Patil as a group, so our cancellation ratio is not more than 1%. Because see, till the time we don't receive 10% as a booking amount, we don't declare that as our pre-sales number. And likewise, if you see, last year, we have sold an inventory worth 2822 crores. And out of that, in the same financial year, we have registered the inventory of around 95%, so which is one of the industry best conversion that we have achieved in last financial year. And going forward also we are confident of, and in terms of the collection, so if our construction progress is fast enough, or that gets reflected into collection numbers, so our pre-sales number and collection numbers are moving hand in hand. So that shows that so there is a right sync between pre-sales, construction progress, and collection efficiency.
Let me get an idea of your new launches. Now, your new launches in Q4 were relatively lower, and I believe what you said in the con call, etc., is also that some of these were postponed. Can you explain why there was a delay in projects? You wanted to achieve certain thresholds. What were those?
One of the key launch that we were anticipating in Q4 was at 24K project at Life Republic, which is our flagship project and contributing almost 50% of our pre-sales number. So over there, we are planning to launch our 24K flagship brand. So instead of in Q4, we are planning to launch that in Q1. So it is just a strategic movement shift from Q4 to Q1, nothing related to any approval. So we have already received the approvals for that sector, and likewise, for a couple of projects, our approval got delayed by 30 to 45 days, and eventually those projects are getting launched in Q1 this quarter itself. And in terms of launch pipeline for the group, since last 2 years, I mean, FY23, we launched around 2,000 crores worth inventory. FY24, we launched around 3,800 crores worth inventory. And this year, we are planning to launch around 8,000 crores worth inventory. So every year, we are doubling our launch, the potential. And that is reflecting into our pre-sales number and likewise per square foot price realization betterment.
What are the strategic reasons for which you wanted to push from Q4 to Q1 of FY25?
Our township is known as a MIG township, and for the first time, we are planning to have a 24K projects over there. So we have explored in terms of the row houses, which is ranging from 2 crores to 4 crores, and we got the significant response in our township. And likewise, we are exploring a premium high-rise development in township. From that perspective, we want to push our current, the RERA launch inventory before we launch this premium inventory at a significantly better price realization.
What is the level of unsold inventory right now, group-wise?
Group-wise unsold inventory will be anywhere between 1,500 to 2,000 crores.
So as a percentage?
As a percentage, it is not more than, whatever is the launch inventory, not more than 25-30%.
So 25 to 30% is still unsold inventory. The reason I ask, Mr. Rahul, is that, of course, you have big plans up ahead. And I'm just wondering if industry-wise, you're seeing that kind of demand continuing. Because this is from the ground, this is the question that is now coming, that now are investors coming back into the market? Have buyers now satisfied their requirement? Is there more? Because all the focus is on premium. Is the demand still sustaining to FY25, FY26 as you're saying?
Yes, certainly. There are a couple of parameters we monitor internally. First is the conversion ratio. So walk-in to conversion ratio is still maintaining across the project, as well as the decision-making time is also equal as compared to last year. On top of that, whatever the inventory that we have launched in last year, out of that, around 50%, I mean, few inventory got launched in the H2, few inventory got launched in the Q4. But still, in the overall capacity, we launched around 3,800 crores inventory. Out of that, around 1,800 crores worth inventory got sold out in the same financial year. That shows, there is a strong demand from a buyer for the right product mix, which is catering to their aspirational needs. And in terms of the premium offering, in the last 10 years, the company has, sold around 2,000 crores worth 24K projects. In the last concluded financial year alone, we have sold around 900 crores worth 24K projects. So customers are well appreciating our premium segment as well.
And Pune has always been an interesting market as well. Thank you so much, Rahul Tadere there of Kolte Patil Developers, talking about their numbers and the plans ahead. We'll take a very short break, but on the other side, the focus is on PSU companies, and we'll be joined by Mirae Assets Fund Manager Gaurav Kocha to talk all about PSU banks and more. Stay tuned.
Gaurav, co-chair fund manager Mirai Asset Investment Managers, joins in to talk to us about the outlook for the PSBs and the BFSI segment at whole. Gaurav, thank you very much for joining us today on the show. Gaurav, just to build some context in, let's start with the constituents of your fund and the performance of the BFSI fund over the last 1 year.
Sure. A very good morning and thanks for inviting me on your channel. Clearly, I think the constituent of the fund, if I speak about it, roughly 2/3 of the portfolio is into large caps, and the remaining 1/3 is a mix of small and mid caps. To give sectoral flavor, roughly 60-65% of the fund is invested in banks because it's into banking and financial services. Around 20% is into NBFCs and financiers, and the remaining 12 to 15% is into the insurance and capital market space. And if I talk about last 1 year, I think returns have been good all across the market. If I look at the benchmark return has been around 15%, and the fund has given around 10 percentage point alpha over benchmark.
Right. Gaurav, we're at the fag end of the earnings season, so I want to get your view on the key takeaways from the overall earnings season. As far as the financial sector is concerned, has the outlook improved as we go into FY25, both for PSBs and private sector banks?
Yeah, I think the results for the quarter gone by has been quite good. If I look at credit growth at a system level, has been holding up quite nicely, above 15%. And if I look at both PSBs and private banks have grown broadly 12 to 15%, and some of the PSBs have grown more than 15%. But if I look at the overall earnings, both on the asset quality front or margins front, I think this has been a very good quarter. So with the repo rate hikes that we had seen about 18 months back, which started 18 months back, that seems to have largely been priced in terms of the cost of funds for banks. And if I look at margins in this quarter, some of the banks reported an improvement in margin, which seems to suggest that the cost of fund repricing is largely done. And from here on, if there are no further rate cuts, at least for the next, let's say, 2 quarters, the margins could hold up at these levels. And we don't see any negative sort of triggers, at least on the margin front, which should keep the earnings benign. And on coming to asset quality, I think this has been another good quarter, another good year on asset quality, where the slippages have been, net slippages have been negligible. And in terms of credit cost also, it's seen an improvement YoY.
Right. Gaurav, the recent past rather has largely been about PSB banks and the outperformance that they've showed, not just against the bank Nifty, but also against the Nifty itself. From where we stand right now, we are talking about bank Nifty looking at 50,000. That's the next sort of line in sight. Where do you feel that gains are going to come from? Do you feel like PSB still have more steam left, or do you feel the action now will move to private sector banks?
I think what we've seen over the last couple of years is a sharp re-rating for PSU banks, which has kind of coincided with underperformance of private banks, and that typically happens in a good cycle. In a benign credit cycle, we see a lot of outperformance of small PSUs and mid-tier banks versus the large private banks. Having said that, if I look at the valuation discount of PSUs to private, I think that's at a decadal low. We have not seen the valuation discount so narrow over the last 10 years. So I think while I agree that in terms of valuation, private banks look quite good, look quite strong. And from here on, I believe taking a 2 to 3 year view, there should be some sort of re-rating for private banks as well, given that the market share gain story still continues. If I look at both on the credit and deposit side, the pace of market share receding has reduced, but at the same time, private continue to gain market share, which is reflecting in their high growth numbers, both on the asset and liability side of the balance sheet. So I think from here on, incrementally taking a 2 to 3 year view, while I like PSU banks as well, I think some bit of outperformance of private could come in.
Gaurav, let's delve a little bit more into the regulator as well. A few days ago, you had that RBI bonanza that is expected to help treasury income for a whole bunch of these PSB banks. There is talk and expectation, now it's been for a while, but reiterating that there could be a rate cut, potentially at least one in FY25. How do you feel that is going to aid growth or help some of these PSBs or private sector banks as well? So if we do get the rate cut, how will things change?
Sure. I think the yields, the bond market yields are clearly reflecting, the dividend payout has been quite strong in this year, which will lead to some bit of fiscal help to the government. And if I look at the rate cut scenario, I think it all starts with how the Fed moves. And you rightly pointed out, I think there is an expectation of around 25 basis point rate cut in this fiscal, and maybe another 25 or 50 basis point in the next fiscal. So we're seeing a very gradual sort of rate cut scenario over the next 12 to 18 months, and nothing going to be rampant, 50 basis point kind of a rate cut in one meeting. Something like that is not high, is unlikely. But having said that, if I look at banks, in terms of the rate cuts, while you're right, there could be some treasury gains for PSU banks largely because of this, because whenever the bond prices move up, there is some bit of gains that they get on mark to market. But the revised RBI guidelines on the treasury book is now, which is kicking off from 1st April 24, will see less volatility in at least the yield book. Because if you look at the AFS book, now everything that gets accounted in the P&L will pass through the reserves. So to that extent, that volatility because of rate movements, be it on the positive side or the negative side, is eliminated. And we see some steady sort of earnings for PSU banks. Coming to the rate cut impact on margins of banks, I think that is the key thing to watch out for. The bank's margins, because RBI has linked bank lending rates to repo rates. So if there is a cut in repo, there is a fall in lending rates. But the key factor here would be the pace of rates coming down. Will it be more gradual? Will it be a 50 basis point like I discussed earlier? If it is gradual, I think the impact on balance sheet and impact on P&L is minimal. Banks get enough time to reprice their deposits or reprice their liabilities at the same pace as the assets. So to that extent, I think the margins outlook for bank in FY25 is quite benign versus FY24.
Gaurav, in the PSU pack, or rather, let's talk about the banking pack as whole. Do you feel like the large cap space offers a lot more value than the broader market names with banks specifically?
Sure. Agreed. I think the re-rating, as I pointed out earlier, that has happened for PSU banks has coincided with the underperformance of the large private banks. And if you look at a long-term history, most of these large cap private banks are trading at 2 standard deviation below their long-term average or meaningfully below their long-term average. So to that extent, mean reversion, given that fundamentals remain intact, and if I look at the cycle, we're still in a good cycle. So some bit of mean reversion could take place in private banks. That should propel at least some outperformance over the medium term.
Gaurav, you keep referring to the fact that the sector has been re-rated, and I want to come back to that, right? Because we've seen several PSPs have gone out and raised capital from the market in order to push business growth, particularly the capex cycle. And if the capex cycle revives post-general elections, you don't feel like there could be another push for a re-rating here, largely given that policy continuity will help these guys who are sitting on big capital exposure anyway.
Right. You're right. I think last 12 to 18 months, a lot of PSBs have raised capital. I think that has to do with a couple of things. As you pointed out, the credit outlook remains benign, and most of these PSBs had low tier 1 earlier. But part of this is also due to meeting the minimum public shareholding by the government. So since government had infused a lot of money over the last 5 years, the government holding had to come down to 75 or below, which has been the case in certain PSBs. So that has been also one of the reasons to raise capital. If I look at the growth in the system is largely 15%. Most of these PSBs are near about that 15% growth. And if I look at their return on equity, which is the accretion to the capital, that is also at around 15%. So I think with 15% growth, and 15% kind of ROE, the capital requirement as such is not a big constraint for them. So I think for that context, they're already trading. Most of the PSBs are trading above book. So to that extent, the valuations seems to be pricing in better growth already.
We've noticed how proactive the regulator has been with banks and NBFCs. How much of a regulatory risk should one take into account while picking a stock from the sector?
That's a very pertinent question here, because over the last at least 1 year or so, the regulator has been quite stringent when it comes to any sort of non-compliance or any sort of loopholes in any bank or any financial institution. So I think that's a very big sort of a risk today, regulatory risk. And we've seen over the years, whenever a regulator comes up with any sort of strict guidelines or strict regulations, it's only helped the system evolve and improve. So I think going by that, I think next 12 to 18 months, we'll see a lot of these non-compliances or lack of compliances in financial institutions being covered, the gaps being filled, and that would only aid better sort of consumer experience and better performance of banks over the long term. So I think this is a good move by the regulator. While it has short-term P&L repercussions for some financial institutions, but it will kind of help them get into the right sort of mindset, and there's a positive sort of a long-term outcome.
Right. I want to talk to you a little bit about capital market players. I don't know whether you have an exposure there, but a whole bunch of stocks and companies which are non-banking in that sense. So anybody servicing the surge that we are seeing in the capital market space has been a beneficiary of flows, and we've seen an impact of that on earnings. How do you feel about that space? Do you feel like that could be a good micro theme to play in the BFSI segment?
Yes, I think you're right. Last 1.5 year, capital market stocks have given remarkable returns. They've been kind of multi-baggers. Many of them have been multi-baggers. If I split that into two broad categories, the one is more sort of brokerages, the sell side scheme of things, and the other are exchanges and AMCs on the other side. I think both of them have done well. If I look at the valuation multiples for them, remember pre-COVID, these businesses used to trade at 20 times 1 year forward, 25 times 1 year forward PE. And now if I look at the multiples, it is trading at close to 35 to 40 times 1 year forward PE. So large part of the re-rating is already in the price. If I look at the earnings momentum has been strong because the markets have been very buoyant. And if I figure that, let's say in the next 12 to 18 months, the markets give a double-digit kind of a return, the pace of earnings growth for these entities at least will remain in the mid-teens or high teens in the next 12 to 18 months. So taking that view, I think the valuation multiples today at 35 times, 40 times kind of will remain sort of there. And if we see some bit of market correction or sideways movement in the market, I think that would be the time when multiples can. So the point I'm making here is that the re-rating potential of capital market stocks is largely behind us. From here, it could be earnings compounding, which would still be healthy in mid to high teens.